Hello traders, welcome to this special Elliott Wave video about the step-by-step process of finding a high probability trade applying the Elliott Wave technique combined with price action and a volume profile. I'm Juan Maldonado and let's start with this great exercise. Alright, traders, here we have our S&P, is the ES futures, and we are finding the end of the corrective leg in order to buy it and target at least the 120 area using the volume profile technique. The volume profile is a technique that shows us the action on this corrective wave. Once we have the end of the corrective wave, we have a discount. Let's suppose that you want to sell ice cream in a park, in the Central Park in New York City. So you are going to buy some ice creams, and you are going to resell these ice creams at a higher price. Of course, as an ice cream trader, you need to find the best price possible, the lowest price possible, the wholesale price. You are not going to buy on the most expensive store near the Central Park and try to resell the ice cream at higher prices. You are going to the producer, you are going to the wholesale guy to buy your ice creams, and then you are going to resell them at a higher price to make some profits. The same happens on the markets, but you need to find where the price is at the wholesale price, when we have a good discount. And that's where the volume profile technique comes to help us. So we know that the fair price of the market, the retail price, is the 821. And currently we are almost at the 700 area. So of course, this is a great opportunity. This is a real trade that we followed on the membership. We have here on Elliott Wave Street a great membership where we make all these market analysis live every day. So this is a real example. So the plan here is buying the S&P. The next challenge here, and is one of the most common mistakes that the trader makes all the time, and is triggering a trade because the analysis. Let's suppose that you have a wave 1 and then you have the wave 2, or you think you're in the wave 2, and you start buying because it's the wave 2, but the wave 2 keeps selling off. This is a great example. You are on the second wave and probably you buy here and the price keeps selling off, and you buy here because now you're seeing divergence on your MACD and the price keeps moving down, and you start losing a lot of money trying to find the end of the second wave because you are thinking that the price is going to reverse. What if not? So in this example here, if the price continues lower and you continue buying and buying and buying, you're going to lose a lot of money. And finally, you find that it was an invalidation and the different wave count is in progress. So of course, this will be extremely frustrating for your trading because at the end, you will be losing a lot of money. So yes, the context is something that we need to have, but also we need to understand where those reversal points are really something. That's the key. The same on the MACD. Imagine buying the divergence on the MACD. Each time you see a divergence, you buy it. Divergence means price reaching lower lows and the MACD doing the opposite. So imagine buying there and losing money all the way down. It doesn't have any sense. If trading was that simple, then I will program in 5 minutes an expert advisor with MACD divergence, or I will hire someone to make the code for me if I don't know how to program or how to develop an expert advisor. And that's it. And then I will go to do different things and my system will make money all the time. No, of course, it doesn't exist. So this is just context, traders. So actually the MACD, what it's telling, and this is optional, is that the price is moving down but a lower rate, a lower speed, losing momentum. That's it, but it's not telling that it's going to reverse. There are different things, You can be traveling in your car at 100 miles per hour, and eventually you reduce the speed to 70 miles per hour. It doesn't mean anything, Doesn't mean that you already reached your destination or that you are going in the wrong way or other things. No, just you reduce the speed. That's it. So it's crazy to think that we are going to invest because the MACD is showing that the price is losing momentum. The real advantage when this is happening, when the price is going down at a lower pace, is that it's a good hint that the big guy is buying while the price is moving down. That's it. But still, we don't know where the market is going to reject or is going to reverse. So this is just analysis, traders. The volume profile, the Elliott wave, the MACD, this other indicator, whatever you like. But something that you need to have in your trading is the setup. When you know that the direction, when you know that the high probability direction is to the upside, the next step is having a system to trigger your trade with a low risk, not buying each low. You are going to lose a lot of money trying to do so. So the next step, traders, is seeing the demand. So for the first time here, we have demand showing up. Okay, that's good. We have a change of behavior. All these concepts, you can learn them in the membership. Look, we have another candle. But buying here? No, it's too expensive. Imagine buying here and leaving a protective stop loss here. That would be crazy. So we have to wait for a discount. But now we have the first part of the puzzle. Okay, the discount starts. Okay, we wait. This is just the wave A. The second wave in the Elliott Wave Theory is going to be a 3-wave sequence. So we have our wave A. Let's wait for the B wave. There it is. So look, we have A. This is the B, and we look for the C leg down. Okay, we wait. But he's not only waiting for the C leg. He's waiting for the C leg, but seeing how the price acts at the previous low. Because if at this stage you have a huge red candle, you can't buy it. Because the common sense tells that we need to have buyers or demand aggressively at this area. Also, the speed of the market really matters. Fast and slow. Right? Fast and slow. Price moving fast in the upward direction and slow in the downward direction. Plus, we have this beautiful candle on the hourly chart telling that we got aggressive demand absorbing all the sellers. So that's where we can say, okay, at the close of the candle, could be here, we can buy it, we leave a protective stop loss here, this is our risk, and this is our potential for profits, the volume profile, fair price, the 820. This is a 100-point S&P trade. Okay, yep, let's do it. Let's trigger the trade right there. And once we trigger the trade, the price starts moving up really fast because it's the wave 3. So that confirms that we are in the right direction. Of course, we're going to have some noise. So here comes the wave 4, normal price action, regular price action. Look, another beautiful hammer. If you like the name of the candles, that's a hammer. So you know that it's time to add to your position, or if you already close your first position because this and that, whatever, you can trigger again. You have the permission because now you have all this momentum. Look at the speed of the market here. So the price then continues higher. Of course, you know that it's going to move up at a lower pace. Remember the 820 area. That's the level that we are waiting for. There we go. Okay, so the price hits the 820. Beautiful setup, 100 points. Then we wait for the price to see where it's likely to finish, and it's likely to finish either at the high or at the high of the profile, that is the 37. The price hits the 36.50, precisely there. Actually a little bit higher, 37.75, and precisely from there, finish that cycle. Look, we're seeing divergence here as well. This is not a sell signal. We don't want to go against the impulse. We want to go against the corrective, right? But of course, with practice, if you like to go against the impulse, you can go ahead and try it. I prefer to go with the impulse and against the corrective waves. And there the price sell-offs and builds the next trade. That is the one that we are already planning for the upcoming week. So that's the process, traders. Remember, never trigger the trade because the analysis. Trigger your trade because you have a setup. That setup should have a low risk, high probability reward if it works at different aspects to your trade. Don't buy or sell the highs or lows. Wait for the proper setup. And that's it. At the end, it's quite simple, following the price and following the setups. I believe that the Elliott Wave Theory is something fantastic. Traders, if you want to buy the membership, if you want to sign up for the membership here on ElliottWaveStreet.com, click on the membership tab, then pick your plan. We have the forex, the stocks, and the full access. You will get immediate access to this analysis in the real markets, in the live markets. Also, we have a new Discord server where we have the community, where we have trading plans and more. We have education as well. So sign up now. We have the special offer of just $19 during the whole month. So you can try out the service just for $19, and you will get immediate access to the Elliott Wave trading plans, analysis, and more, and education. So that's the plan. Please have a fantastic trading session. I'll see you soon. Take care. Bye-bye.